Even if you shut down the Pentagon today and disable the U.S. military, lower interest rates to zero and pay no interest on the national debt, Washington would still be running a deficit due to Social Security, Medicare, and Medicaid, not to mention income security. The fact of the matter is that the U.S. is on an unsustainable path, only kept in place by the fact that other countries are doing even worse. But that's not something to be proud of. Before the Industrial Revolution and throughout human history, there was no such thing as entitlements and social programs. Right now, we feel that it's part of life, but we need to get accustomed to the dangers it poses. Michael Pento is adamant that this economy will collapse under its own weight and tells Wealth Research Group how he's preparing and what to be most aware of.
Welcome to the Titans of Industry Show. I have a first-time guest on, a very smart guy. I've never had him on myself, but absolutely one of the favorites on YouTube, and a phenomenal expert, especially in the topic of gold, which we're going to cover today. We're also going to cover some stock market, Federal Reserve policy, and just a little bit of what's going on with cryptocurrencies, specifically Libra, and how it affects the dollar. Michael, first of all, Michael Pento, pentoport.com. Thank you for joining us.
Thank you for having me on, Lior.
Well, you know what, Michael? I'd love to start by asking you to address a topic that was first published by Ray Dalio a couple of days ago on his LinkedIn user. He publishes these lengthy articles periodically in the last 2 years, more than before. And he talked about the fact that he thinks that in the coming decade, bonds, negative yielding bonds, will stop to be viewed as a safe haven. In other words, they will stop to be viewed as instruments that are cash, that are the best cash alternatives, and therefore part of the 13 trillion that's already in negative yielding bonds, and part of the issuance going forward by government will be viewed in investors' eyes as risky and not as a safe haven. And they'll
I'm sorry for laughing. It's just funny, Lior, that people say that they're going to come to this epiphany that a bond that pays you nothing, you have to pay and lose money on your principal, a certain percentage every year, and people are going to someday think that that's risky someday. I mean, shouldn't it be risky, prima facie case, for it to be risky now?
Definitely in all logic and everything like that. But what Dalio is addressing is the fact that $13 trillion are getting invested in these bonds, and what he's seeing is that this group, the group that is willing to lend money to governments and get zero income for it, will start to see that there is the upside of doing even that is not there anymore, and he is getting gold mad. In fact, Dalio's fund is the 5th largest holder of GLD. And so he's already a major player in the gold market, and now he's saying this could be gold's decade. A little bit about this theory already I picked up from your view just a couple of minutes before, when you said, I don't understand why people even consider it to be a safe haven now. But can you talk about a little bit about why Dalio believes that there's a shift? And the reason he says there's a shift is because he talks about the unfunded liabilities becoming even a greater part of government deficits, and he even believes that governments will start to devalue currency outright, directly, as a matter of policy.
Well, that's already, Lior, that's already happening. I mean, I don't know Ray Dalio. He's certainly a mentor of mine. He's someone who should be looked up to, but I don't know him personally, so I can't tell you what Ray Dalio is thinking. I will tell you the insanity of negative yielding bonds will come to the fore in the very near future. it just can't last much longer, especially in light of the fact that your nominal rates are negative, 13 trillion, you say 13 trillion, that's correct, an all-time record high sovereign debt, because that has a negative yield. There are 14 companies in Europe that have negative yield that are rated junk bonds. Italy just floated a 50-year bond with a yield of 2.8%. Austria floated a 100-year bond with an interest rate of 1.2%. So I wrote a book in 2012, 2013, The Coming Bond Market Collapse. I never even dreamed, conceived, or fantasized at that time that rates would go as low as they have gone. But Ray Dalio, I believe, is correct, and I'm going to be correct, that there's going to be a massive interest rate shock coming like we've never seen before. It's going to blow up the whole global equity market and global economies. Because when you think about what happens, Lior, when you take rates down to zero and below and leave them there for a decade, you take on a lot more debt. People tend to borrow a lot of money when they get paid to borrow. Makes sense, right? You also engender and foment massive asset bubbles, not only in the entire fixed income spectrum, but also in the equity market and the global real estate market. And the arch enemy of bonds is what? It's inflation. What is the primary goal of every horrible, horrific central bank on the planet now is not monetary stability. It's not stable money. It's an inflation rate of at least 2% the way they measure it. So someday, and I believe it could happen very soon in the next few years, at the very most in duration, you're going to get an inflation rate of, by the way, let me just parenthetically add that we already have a 2.1% year over year inflation rate on the consumer price index. But the Fed doesn't care about that. Our central bank, the Federal Reserve, cares about core PCE. So it's a further bastardization of the way a government measures inflation. But the way I want to phrase this is you're going to have even more yields negative, other than 13 trillion. You're going to have more junk bonds negative than 14 companies, because Mario Draghi, and soon to be replaced by Madame Lagarde, is going to go back into QE. What are they going to buy? They're going to buy more corporate bonds, forcing more bonds below zero. Japan already has a negative deposit rate. So you're going to have, and by the way, the Fed is going back to zero. You're going to have a further infusion of jet fuel into the bubble and fixed income. And that's going to burst in violent fashion because you're going to get the achievement of central banks' inflation targets. So if you have inflation above 2% and rising, then you have central banks forced to step away from manipulation of the yield curve, and all of the private investors in fixed income that have been front-running central bank bids will now be front-running central bank offers. And you're going to get a yield shock like you've never seen before. But when you have engendered so much more debt onto the global financial system, and you have asset bubbles that make no sense outside of the twilight zone, those skyrocketing yields, it's going to occur in the matter of just a few weeks. Now, I don't mean it's going to start a few weeks from now. I mean that blow up in the bond market whenever it begins will be like a volcano exploding, sending massive repercussions throughout the world of equities, and I think the wipeout is going to be complete.
Michael, how do people or how do you judge what should be the price of gold in light of what you're saying?
Well, the drivers of gold. Let's just talk about the dollar price of gold. Gold is making, new highs in other currencies other than the U.S. dollar. We're still about $500 an ounce away from a new high in gold in terms of dollars. So what drives the gold price is what has always driven the gold price in dollars. It's just a better currency. It's an alternative currency to the US dollar. You'll need a falling US dollar in the context of falling real interest rates. Well, nominal interest rates, as we just went through, are in Japan negative, in the Eurozone negative. They're going to be going more negative because you're going to get more QE from the ECB. The Fed is going back to zero. So nominal interest rates will be zero or below around the world. And at the same time, you have this asinine pursuit of inflation. So we got that covered. Real interest rates are falling and will be falling much faster over the next few years, most likely. And on top of that, if the Federal Reserve starts heading towards zero, that interest rate differential between our Fed, which is about 2.4% on the effective Fed funds rate, and the differential between that and the ECB and BOJ will go away. It will narrow greatly. So I think the dollar will lose its bid, and you'll get more and more negative yields throughout the world in a real sense and in a nominal sense. So I think gold goes to an all-time high in the next, say, 16 to 18 months.
Okay, I want to ask you why do governments have a problem that is not fixable in your mind, or is, when it comes to their entitlements, and politically, what can they do? Which demographics are going to suffer from what's happening? Do you see the United States government doing any sort of austerity measures, any sort of stipulations on Social Security? Things like, if you don't work or show us a pay stub, you're not eligible for Social Security. If you're overweight or you can't pass some medical test, then you can apply for health cares. Do you see any austerity measure? Do you see any raise in taxes? Do you see anything that the government will do to either tackle their unfunded liabilities in a real sense, in other words, something that would hurt the population directly, and not by inflating or something that is indirect, but something that they will have to announce to the public that they're doing, which will have consequences, or to the flip side, to the funders of this via taxes? Do you see any of that, or do you feel that they'll take more of a path of a least resistance and use some sort of a inflationary tool to get around this? How does the United States government continue to fund its liabilities in the coming decade?
Well, I don't see anybody on either party that espouses a balanced budget any longer. And about 70% of the budget is on autopilot, the entitlement programs, Medicare, Medicaid, Social Security. Then you have defense thrown in there. A very small part of the budget is non-discretionary. So there isn't anybody now, not Trump, not any Republican, and not any Democrat, that's talking about a balanced budget or cutting our entitlement program. So that's off the table. And by the way, why do it anyway when you have a bunch of people running out there, a bunch of Keynesians who talk about modern monetary theory, which we've already tried? We've already monetized on a permanent basis about $2.8 trillion of government debt. We had a balance sheet of around $780 billion prior to the crisis. We increased the Fed's balance sheet to $4.5 trillion. We were supposed to drain that balance sheet through quantitative tightening back to about $2 trillion. That went out the window, Lior. We're going to be stuck at around a $3.5 trillion worth of monetary base. So we've permanently monetized all of trillions of dollars worth of debt, and interest rates are falling around the world. We just went over it. I gave you a plethora worth of examples of how negative nominal rates are around the world. And almost, if you go out, you can go out 10 years in Japan, 10 years in Europe, and rates are negative. So there's been Italy's bankrupt, Southern Europe is bankrupt. The banking system in Europe is bankrupt. Japan is an insolvent nation. The United States has, believe me, we're not alone in the insolvency crisis that's coming. The United States has 340% debt to GDP ratio, total debt, public and private. That is at an all-time high, and our GDP is phony. So, the idea now is you could just print money. Why even bother taxing anybody? Why even bother going to work? Of course, I'm speaking sarcastically, but this is the new view. The new Keynesian, the neo-Keynesianism is we don't need to work or tax or do anything anymore. We could just print money, hand it to people, and permanently monetize it. We don't even have to, by the way, Lior, we don't even have to go through the pretense of taking out debt. Okay, we could just print money and hand it to people. So we don't have to issue debt, have the central bank buy it, and then permanently monetize it later, which is what we've already done to the tune of trillions of dollars. We'll just print money and hand it to people. That's where we're headed. So the idea of living in reality, I mean, why live in reality when you've got trillions of dollars worth of sovereign debt with a negative yield? Why live in reality if corporations can float junk bonds and get paid to do it, even though they're going to most likely default on the principal? Where is the call for reality? It's not going to come until after we have what I just spoke about, which is a complete and total annihilation of the bond market. When that occurs, you're going to have some reset, a real and honest restructuring of the debt. That is when you're going to have some semblance of normalcy. But it's not going to come, I'm afraid to say, it's not going to come until after we try to hyperinflate the whole thing away on a global basis.
Is there any logic or any strategy that you've come across that makes sense to borrow in light of this, to borrow dollars in real terms today as an investor? With
sure, if you could,
sure. Talk a little bit about that.
Lior, if you could borrow on a fixed basis any kind of money, why not do it? Because the strategy of central banks is just to inflate it all away. I mean, if your income is your income, the current dollars you're taking in from investments, your income should all be inflation adjusted. So your income is going to be rising. The income you get from your assets is going to be rising, but the fixed cost of your debt stays where it is. So you can take a mortgage out for 3.5% on a 30-year fixed here in the United States, or maybe even less, and inflation's going much higher, why not do it? Makes sense, right?
Interesting. Are you, in light of this, are you personally, or do you see justification of investing in single-family homes in the United States right now, in particular markets that are more fundamentally attractive in that case?
Well, no, I don't. First of all, I am not totally convinced that we're out of the disinflation or deflationary danger that we have been for the past several years. But we're gonna know a heck of a lot more on July 31st of this year, when Jerome Powell has to come out and really weaken the U.S. dollar. Otherwise, the bond market, the stock market is going to collapse, in my opinion. So we are now anticipating a 25 basis point, 100% chance, virtually 100% chance on July 31st for the Fed to come out with a 25 basis point rate reduction. We also have about a 50% chance that rate reduction will be 50 basis points. Mr. Powell also has to be very dovish about the future direction of the Fed funds rate, and to add a little, cream on the cake, icing on the cake, he should also stop quantitative tightening, which is still going on. The Fed is still slowly draining its balance sheet. It's not supposed to stop until September. So the Fed has to do these things. By the way, I don't want the Fed to do any of the things that I just mentioned. What I'm saying is the Fed is so so much telegraphed this type of dramatic easing that if they don't do it, if the Fed just comes out on July 31st and cuts 25 basis points, leaves the balance sheet quantitative tightening program in place, doesn't portray a path of more loosening, then I think the dollar could surge, and I think the stock market could absolutely tank. So Mr. Powell has his work cut out for him, but I'm not entirely convinced that the upward pressure on the U.S. dollar and the deflationary forces of gravity have been repelled just by a 25 basis point rate cut that's already been priced into the stock market. Mr. Powell, if he wants the dollar down and if he wants to push more jet fuel into the bubbles that he has further fomented, he must aggressively cut interest rates, let everybody know that he's heading back to zero. On July 31st, he has to do this so he can keep up with Mario Draghi and Madame Lagarde, who are not only stuck at a negative deposit rate with their banking system, their banking system rates, their deposit rates will be going further negative, and he's going to restart QE. So if he doesn't want the dollar to surge, which is disinflationary, he has to surprise markets to the dovish side. I am not convinced he's going to be ready to acquiesce yet, although I am convinced he eventually has to be there. That's where he's going to be.
Michael, what do you...
I'm sorry, I want to add one thing.
Go ahead.
Lior, sometime between 1913, the formation of the Federal Reserve Act, and 1987 or 1971, when we broke the gold window, then 87 is when it really became a salient issue. The central bank no longer decided to be the banker's bank, no longer was an emergency lender of last resort at a penalty rate at the discount window. The central bank got into the business of repealing the business cycle, repealing recessions, and making sure stocks, bonds, and real estate never have a downtick, never have a correction. So it was 87, then late 90s, then 2001, and then 2007, and then today. So that's the new mandate for the Federal Reserve is no longer stable prices, and stable prices being defined as no inflation, and full employment. It is repeal the business cycle and keep asset bubbles afloat.
Michael, in the past few days, when we saw Jerome Powell going on testimony with Congress, in the second day, every other question was about the Libra project. On one hand, Congress doesn't want to, in their words, doesn't want to curtail innovation. They don't want to tell companies, hey, don't innovate, because obviously that puts pressure on corporations to change their domicile, go elsewhere, etc. On the flip side, the Libra does pose threats to currency, threats to consumers, etc. So many things with corporate coins are unique because some corporations on the retail side, they reach far more people than the everyday government does. Retail-wise, the United States is about 5% of the world's population. It is the biggest service economy on the planet, but Facebook reaches unbanked people, right? Facebook reaches 2.5 billion people. Not that they all would use Facebook for transactions, but once obviously Facebook comes along, if it does this successfully, other corporations its size or even bigger would look to compete if there's profit and margin there. Could you talk a little bit about this? Is this something that is a threat to the reserve currency more than other countries pose a threat to the reserve currency?
No, I hope I'm not disappointing you, but I don't think Libra is a threat to much of anything. I mean, Libra is not, I don't believe Libra is a cryptocurrency. I think it's an electronic currency. There is a difference. A true cryptocurrency is a currency that is immutable. The transactions would be decentralized, immutable, and anonymous. The fact that
Sure, I called it a corporate coin. It's not a cryptocurrency.
yeah, it's a corporate coin, which is like a Venmo. I mean, I have no issue. I don't think the State Department, the Treasury, has any issue with electronic money that's based in dollars. So moving dollars electronically, seamlessly, automatically, I don't think anybody has a problem with, because they're subject to KYC, know your customer, anti-money laundering laws. They're not immutable. They're not anonymous. They're not decentralized. I don't think anybody has a problem with Facebook's currency, as long as it's not a cryptocurrency, as long as it's not decentralized and immutable and anonymous. That's Bitcoin. That's when the State Department, the Treasury has a problem with it. That's when they will regulate it. And yes, you can regulate Bitcoin. Eventually, what I believe is going to happen with all true cryptocurrencies that move money along the blockchain in that anonymous decentralized fashion, is they'll be made illegal. So you say the exchanges are banned. You ban all exchanges, and anyone caught transacting either on the web or the dark web is fined or imprisoned. So then the only people using cryptocurrencies will those that are trying to escape capital controls or hyperinflation. So they'll go on the dark web and they'll move their money overseas in an act of desperation. So countries that are experiencing hyperinflation or they have capital controls, criminals. So there is and there always will be a market for cryptocurrencies. I just don't think it'll ever be accepted by the masses or allowed to be used by the masses. So I think the value of a cryptocurrency is probably, maybe for Bitcoin, maybe, sub $100 per unit. That's where I think we end up. But I'm all for Facebook's Libra currency. Absolutely. As long as it's an electronic form of payment, like we have Venmo. There's a lot of ways to move dollars electronically with less friction. If that's what Libra is going to become, then I think it's going to be a big hit. One of many, though, not just one.
Michael, could you tell people a little bit about the pentoport.com? What is it and everything like that?
Sure. So it's basically twofold. So I manage money. Come to the website, it's pentoport.com. My email address, you can email me directly. It's mpento@pentoport.com. So I have an inflation, deflation, and economic cycle model. So the most important thing that you should think of when it comes to investing is where is the economy regarding the dynamics of inflation, deflation, and boom and recession. And if you could, I have a model that determines where we are. So should I own momentum stocks? Or should I own low beta stocks? Should I own bonds or should I short bonds? Should I be long gold or should I be short gold? And if you understand where we are in terms of inflation, deflation, and a growing economy or a recessionary economy, not only do you have a chance of making money while things are good, but you also can protect your principal and make money, because I short stocks as well, when we finally get this correction. And I think when we finally hit the wall, it's going to be a massive and chaotic repricing of bonds and equities. So this is the way to go, if you ask me. So I also have a podcast. If you don't meet, we have a $100,000 minimum investment. If you don't meet that, we have a podcast, $49.99 per year, which tells you my thoughts at a 36,000 foot level. Unique thoughts that you won't find on financial media, which they tend to myopically focus on the inane and fatuous aspects of the market and ignore what's really important.
Michael Pento, thank you very much for taking the time, and we'll definitely circle back.
I look forward to it, Lior.
Thank you, sir.
Michael Pento warns of a dollar meltdown. Wealth Research Group is incredibly bullish on silver in light of its 85-to-1 ratio to gold. In fact, go to wealthresearchgroup.com/ratio and wealthresearchgroup.com/rally to understand just how unique the silver opportunity is. Make sure to check out the upcoming interviews with our major speakers from TEDx, as well as top investors and economists.